My name is JC Parets. Thank you everybody for coming. I founded allstarcharts.com back in 2011, so we've passed the 5-year mark, and what started off as a humble blog just to share some ideas that I was looking at, really turned into a lot of invitations to speak at various universities, Harvard and Duke, and presentations all over the country and internationally as well. And ultimately I launched my own firm in 2012, and we're fortunate enough that things are going great and we're off to the best year we've ever had. So I'm going to share a few ideas with you guys, and for you guys that don't follow me on StockTwits or Twitter, I'm at AllStarCharts, and all of my stuff can be found at allstarcharts.com. So without further ado, so here's the agenda for today. We're going to go over a few technical tools that I think are important. Yes, I passed my Chartered Market Technician designation in 2008, Jim. So yes, I am 100% a technician. So we'll start off with a few basic principles that I think are worth out. Then, we're going to talk about the top-down approach, how it's not just looking at one indicator or looking at one asset class, but taking the entire weight of the evidence and bringing it all together to find the best risk-reward propositions. This isn't about I'm an options trader, so I'm going to teach you everything about options, or I'm a technology trader, so I'm going to teach you everything about tech. We look at stocks, bonds, commodities, currencies. We look at all of the different sectors. We don't necessarily have to use just options. I think there are perfectly good reasons to equities as well, and it's really about using all of the asset classes to your advantage. So that's really what I think that where we bring value is kind of really bringing it all together. We're going to talk about technology, the recent weakness, the financials, how important they are to the market currently. We're going to look at commodities, gold, silver, oil, natural gas. Then we'll give you a quick little tour through allstarcharts.com, show you guys around, and then we're going to finish up with what I think is the best trade in the world today. Jimmy wants to know if I just trade and not invest. There's a fine line between both definitions. What somebody considers an investment, somebody else might consider just a trade. So I would consider that both. We look at both long-term pictures and hold things for months or years at a time, and we could be as short-term as just a few days or a few weeks. So I would. The beauty of technical analysis is that it's fractal. So the principles that we're talking about on a daily basis can also be applied on weekly time frames or monthly time frames. So regardless of whether you're a short-term trader or a long-term investor, all of the principles that we're talking about today can be applied regardless of the time horizon. So Jimmy, I hope that answers your question. Just so you guys know, this makes my attorneys very happy. Everything we talk about going forward, guys, it's strictly for informational purposes. Nothing you see here is any solicitation for any hedge fund that I might manage. None of the things we talk about is any kind of buy or sell recommendation. So before you act on anything that we discuss here, make sure that you've consulted your advisor and your accountants, and make sure that you're suitable to be doing some of the things that we're discussing. So real quick, guys, let's go over technical analysis before we get into the charts, so you guys know what it is that I'm talking about. Technical analysis, there's a lot of misconceptions as to what it is, but at the end of the day, all it is the study of the market itself and the behavior of the market, and more importantly, market participants. So regardless of how many iPhones Apple is selling or how many shoes Nike is selling, the price of the stock is going to go up if there are more buyers than sellers. If there's more buying pressure than selling pressure. That's the bottom line, regardless of the reason. And that same analysis can be applied not just to Apple and Nike and other stocks, but also to crude oil and gold and silver and sugar and corn and coffee and cocoa and euro dollar and Japanese yen. All of these principles can be applied regardless of the time horizon and regardless of the asset class. So let's go over diversification real quick. A lot of people talk about, JC, I'm diversified because I own financials and I own some tech and I've got some energy, so I'm definitely diversified. But the reality of the matter is that you're not. And this is a simple correlation matrix where you've got all 9 S&P sectors on the y-axis and all 9 S&P sectors on the x-axis. And the more green and it compares each sector to itself and finds the correlation coefficient over a given year, and the more green that it is, the closer to 1. In other words, the more they move together. The closer to 0 they are, the less it moves together. So as you can see here, there's a lot of green on this screen, and the reason is very simple, is because although there are various sectors, all different sectors, industrial, staples, technology, utilities, although there are many sectors, at the end of the day, they're all U.S. stocks, so they really move together. here's the exact same correlation matrix, except instead of all S&P sectors, we're looking at 20 different countries on the x-axis and 20 different countries on the y-axis. So notice how there's a lot less green here, a lot more orange and gray. And the reason is because if you're looking outside the U.S. borders, there is less correlation between these countries' indexes. So true diversification and really having non-correlated positions in your portfolio means looking outside of the United States. And this is 2016, guys. If you're not already doing this, I think you're selling yourself short. So the reason I bring this up is to really kind of drive home the fact that just being in the United States, I think, is irresponsible. I think if you're going to try to be making money consistently in the market, you have to look outside the borders. And by the way, these stocks and these indexes and ETFs are all traded in the United States. So it's not like you have to go to some exchange in some country that you've never heard of in order to put a position. Most of the stuff is traded on the NASDAQ or the New York Stock Exchange. So we treat everything the exact same way. So whether we're looking at shares of Intel or Apple or Microsoft, we look at it the exact same way. Crude oil futures or wheat futures or the regional bank index or the euro or Greece. It's all the same thing. It's just letters and math. So we do not want to have any, and this has nothing to do with central banks, Jim. This is just simply diversification. This was the case well before central banks started doing anything. So we, regardless of what's happening in the economy, be looking all over the world and treat everything exactly the same. It's just letters and math. That's all it is. We don't want to have any emotions behind that. So let's go over what I think is the most important principle that we're going to talk about today. You guys can feel free to just leave after this. If this is the one thing that you pay attention to, you know, this is it. And it's really that former support turns into resistance. This is what we call polarity. So let's call this blue line price and this red line where prices, there's really an inflection point in price. Notice how every time, let's just call this Microsoft for argument's sake, and let's call that red line 40 bucks. Every time Microsoft gets down to 40 bucks, it bounces. Why? Because there's more demand than supply. There are more buyers than sellers in Microsoft at $40 for whatever the reason. I'm sure that these buyers have perfectly good reason, but it doesn't matter to us. The market is proving to us that this is just simply the case. At $40, there are more buyers than sellers. Now, the more times that a level is tested, the higher the likelihood that it's going to break. And the reason is that eventually anybody willing to buy at that $40, there comes a point where they have already done so. They've already done their buying, and there comes a point where there just aren't any buyers left. And that's when prices, quote unquote, break down. They break that support. And that's the market suggesting to us that at that $40 level, where there was more demand than supply, where there were more buyers and sellers, is now the opposite. The sellers have now taken over. There is now more supply than demand at that price, and that's why prices fell below that level. That's why anytime prices return to that $40, right? Let's say the prices broke 40 and head down to 30, for argument's sake. The market knows, we know the market is already telling us that there's more sellers and buyers at 40, and that's why any rally back to that former level of support, that $40 level, it rolls over from there because we know there's more supply than demand. There's more selling than buying. So that way, what you want to understand is that they're always shifting. Former support turns into resistance, and former resistance turns into support. It's the same thing when, let's call this 40 bucks and Microsoft. Why? Because there is more supply than demand right here. Every time it gets here, it sells off. Rallies back, sells off. Rallies back, sells off. Eventually, anybody willing to sell at this level has already done so, and prices, quote unquote, break out, right? This is the market suggesting that at this level where there were more sellers than buyers, there are now more buyers than sellers. There is now more demand than supply at $40. Therefore, on any kickback to former resistance, that level turns into support. So this is Polarity 101, guys. This is the most important thing we're going to talk about today. So obviously, the market doesn't make it that easy on us. So a lot of times you get failed breakouts, and I've read a lot of technical analysis books, and I know a lot of technicians, and what I have found is that a lot of people say to be careful for the failed breakout. In other words, buy the stock when we make a new high, but be careful, it might be a failed breakout. So it's always kind of like it always has a negative connotation. My argument would be, let's find these. Let's look for these opportunities, because from failed moves come very fast moves in the opposite direction. And I'll explain to you why, and I'm going to show you guys some examples. But let's go over the psychology real quick. Let's just call this $40, right? Every time prices rally into this level, it sells off because that's resistance, and then we break out. We break out to a new 52-week high. The 26-year-old journalist at, media outlet du jour wakes up that morning, makes a few phone calls. There might be an earnings release that morning, an M&A. Something happened where this 26-year-old journalist feels that it's worth blatantly making up a headline for these new highs, right? So what happens? Anybody who's waiting for the breakout buys the breakout to new highs. Anybody who was short at these levels has a stop loss above those former highs, gets stopped out. So you get all of this buying on the new highs, you get the headlines, and then a few days later, prices start to break down, right? So what happens? Anybody who bought the breakout is now wrong. The only way to unwind that trade is to sell the stock. Anybody who was short that got stopped out is now no longer in the trade. In order to be back in that trade, they have to resell the stock short. So that's why, and then we start to recognize that. The momentum players then come in. That's us. And we then short it. And that creates even more longs having to sell their positions, and even more former shorts that got stopped out now have to short it again, right? So that's why from failed moves come very fast moves in the opposite direction. So from our perspective, how do we enter? When you start to notice these, and we're going to go over a few ways to be able to anticipate these failed moves. Let's just call this $40, and price breaks out and goes to 41.5 or 42. When price breaks back below $40, that's our entry point. 39.90, 39.85, right? So the stop loss is back above 40. So what's the risk? 15 cents. If we're right, it's a home run. We're talking $4 or $5 a share. So from a risk-reward standpoint, it is very, very much skewed in our favor. And it works in both ways, guys. Let's just call this Microsoft, and let's call this $40. Every time prices get down to this level, prices bounce. Why? Because there is more demand and supply. There are more buyers than sellers. But then what happens? Prices breaks to a new low. The 26-year-old journalist at media outlet du jour blatantly makes up a headline for the reason for those new shorts, even though he or she has zero idea of why this is taking place. It's their job to blatantly make up a headline. So you get the new lows, right? And then anybody who is long and says, I'm going to be long only above this level, gets stopped out of their positions. Anybody who's looking to short gets short upon the break. But what happens? A few days later, prices starts getting back above that $40 level. Anybody who got short is now wrong. The only way to unwind that trade is to buy it back. Anybody who was long and got stopped out is now no longer in the trade watching the stock rally, so they have to buy it back. That brings in the momentum players. That's us. We jump on board, which creates even more of a short squeeze, which creates even more longs that got stopped out having to buy it back. And that's why from failed breakdowns, you get squeezes in the opposite direction, right? So what's the entry point? Same as before. Let's call this $40. Price breaks down, goes to 38.5, 39. A few days later, starts creeping back above 40. When it gets back above 40, 40.05, 40.10, 40.15, that's where we buy it. We put our stop below 40, so if prices break back below that, all bets are off. What's the risk? 15, 20 cents. But from a reward standpoint, we're looking at 5, 10 points to the upside. So a very, very obnoxious sort of squeeze takes place from failed moves. So a good example of this is actually gold miners in January. And for you guys that, if you guys go to allstarcharts.com/profits, we have a deep discount that we'll go over in a second. But we were talking about buying gold miners when it got above 13 and they doubled from there. But the risk, more importantly, it doesn't matter that we were right. The risk was so well defined because you're getting in at 13.25. If it breaks back below 13 in gold miners, all bets are off. So here's another great example of this, and let's just let's go over this, right? So support, 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 break, short squeeze, right? Support, 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 break, short squeeze. This is U.S. Treasury bonds at the end of 2013. This is TLT, textbook breakdown at the end of December. From failed moves come fast moves in the opposite direction. I think this is just a perfect example of the powerful moves that are created from these failed breakdowns. So not only do we not want to worry about them, we want to anticipate them and look to profit. Same thing, you guys have heard Head and Shoulders tops. People are always looking for them. It's very popular, probably because it has a silly name. But the truth of the matter is it's actually very rare. So the book says you have a left shoulder, a head, a right shoulder, and you short the break, right? But more often than not, you get that break, and a couple of days later, you get back above support. So anybody who shorted on the break is now wrong. Anybody who got stopped when it broke to new lows now has to buy it back to get back in the trade, and that's why from failed moves come fast moves in the opposite direction. We see it in patterns all over the place. Here's a great example of that. This is summer of 2010. This is the S&P 500. Left shoulder, head, right shoulder. Prices break in the summer of 2010. I recall on CNBC, Sue Herrera. Sure, she's a very nice lady, but she is clearly not a technician. She preached to everybody how the head and shoulders pattern is now complete and the market is now heading lower. So here's a great example of a journalist. I don't know her personally. I'm sure she's very nice. I don't mean to pick on her, but this is just a good example. So perfect example of a journalist thinking she's a technician, and from failed moves come fast moves in the opposite direction. We all know what happened after that. So a beautiful, beautiful thing. So let's go over momentum before we get into the charts. I use the relative strength index, not relative strength. Relative strength is one security versus another, which we'll go over in a minute. Relative strength index is a measure of momentum. I use a 14-period RSI. When I say period, I mean that on a daily chart, we're looking at 14-day RSI. On a weekly chart, we're looking at a 14-week RSI. Okay, that's what period means. And it's an oscillator, which all that means is that it moves from 0 to 100. So oscillator might be a fancy word that I can barely spell, but all it means is that it's an indicator that goes from 0 to 100. And that's what RSI is. So there's two ways to take a look at this. The first way we want to look at it, just real quick, we look at RSI and we want to know if it's in a bullish range or in a bearish range. When a stock or any asset, it could be an ETF, it could be a commodity, it could be a currency, when you're in a strong uptrend and you get rallies uptrend in price, momentum is going to reach overbought conditions, which traditionally is 70, and oversold is 30, right? Nothing goes straight up, however. So on rallies and uptrends, you're going to tend to get overbought readings, but during corrections and uptrends, momentum is going to stay above 30. You're not going to get those oversold readings in a strong uptrend. So when you talk about how something is overbought and that has a negative connotation to it, it's actually a good thing. It's actually a positive thing. How can an overwhelming amount of buying be a negative? Okay, think of it like that. You use 40 and 60. That's terrific, Jim. I use 70 and 30. If you're in a downtrend, right, in sell-offs, in downtrends, in price, momentum is going to get oversold. You're going to get oversold readings on those sell-offs in a downtrend. However, nothing goes straight down, right? So on counter-trend rallies, on corrective rallies within a downtrend, momentum is going to fail to get above 70. It's probably going to run into 60 and find resistance there, as Jim Valentine is suggesting that he uses it. So when you're in a strong downtrend, momentum is not going to get overbought on those counter-trend rallies. You're going to get sell-offs, right? And the worst downtrends, the strongest downtrends, fail to get above 50 on any counter-trend rallies. Same thing on the bullish side. On strong uptrends, corrections within uptrends, momentum is going to stay above 50. So just something to keep an eye on. Very simple way just to see if a market is in a bullish or bearish range. The second way and final way that I use momentum is think of it as a tennis ball. Throw a tennis ball up in the air, right? Before it hits its peak and starts to fall, you can already tell momentum is slowing down. Same way with the market. So when you have an uptrend, which is a series of higher highs and higher lows, when you get a higher high and momentum puts in a lower high, that's what we call a bearish momentum divergence. That's a signal that the trend is changing. Not necessarily reversing, but definitely changing. That's what we call a bearish momentum divergence. Same thing to the downside. When you have a downtrend and you have lower lows and lower highs, that is a downtrend, but when markets put in a lower low and momentum puts in a higher low, as it did here, that's a signal that the trend is changing. This is actually silver in the summer of 2012. We put in a lower low in the middle of the summer, a higher low in momentum. The trend changed from a downtrend to a sideways trend and then broke out and had a monster rip over the next 6 months. So let's get into the charts. There's the reason, and there are some people here that have been following me for a long time. We've been essentially saying to stay out of the market from any sort of structural perspective since last summer, really since late spring last year. And although we did get bullish at the end of January, and I'll explain to you why, from any structural perspective, we've been bearish, and that remains the same. Here's the NASDAQ composite. It took 15 years to get back to those March 2001 highs. 15 years to get back up to that resistance. To think that we're just going to rip right through that, like that level doesn't exist, I think would be extremely irresponsible. So that resistance from 15 years ago is still there. So there's been no reason to be long the market as a whole since last May when we ran into that resistance. Let the market prove that it can get above that, and obviously it has not proved. Here's a monthly chart of the NASDAQ 100 and a bearish momentum divergence. It looks like a failed breakout to me, and the fact that it's about to fall off a cliff. That's how it looks like to me. So if you want to be short from any sort of tactical or structural perspective, I think you could be short the NASDAQ as long as we are below the March 2000 highs. We only have 45 minutes here today, guys. So for you guys that are interested in Fibonacci, feel free to email me, jc@allstarcharts.com, and I'm happy to send you some information on the subject. It's very powerful stuff. But the bottom line is, in this case, while the NASDAQ composite last May was running into that former resistance from March of 2000, the S&P 500 was running into the 161.8% extension of the entire 2007 to 2009 decline. So multiple, again, it's not one indicator. It's not one thing. Here we are looking at the S&P 500, Jaimini. It's not one indicator that we're looking at. We want to look at the weight of the evidence. We want to look at the entire market. So here are two of the most important indexes in the world saying last May to get out of the way of stocks. Meanwhile, the New York Stock Exchange Composite, which is much more global, the New York Stock Exchange Composite is a cap-weighted index, and over half of the biggest 100 companies in the NASDAQ composite are foreign companies. They're not even in the United States. So it's a much more global, diversified index saying the same thing last May, get out of the way. Simple trend line analysis. We broke the uptrend line from the 2009 lows. If you look at nothing else, it would have kept you out of the market since last May. And then here's a shorter term look of what was happening last May. This is why we went over that at the beginning. From failed moves come fast moves in the opposite direction, guys, right? So here's the breakout, quote unquote, above that former resistance from the prior year. That failed, and we got a fast move in the opposite direction. That's why I wanted to show you guys some of those principles. So again, more evidence suggesting, this is April of last year, suggesting that there was no reason to be long the market overall. Meanwhile, the internals of the market were deteriorating last summer with higher highs that we were seeing. This is the list of stocks on the New York Stock Exchange making new 52-week highs. When prices of the indexes are making new highs, you want to see an expansion of participation. You want to see more stocks making new highs as well, essentially confirming what the index is doing. Because at the end of the day, we talk about the S&P 500 and the Dow Jones Industrial Average and all these indexes, but they are made up of components. They are made up of stocks. So this is a market of stocks, not a stock market, right? So notice how with each higher high last summer in the S&P 500, the New York Stock Exchange, the stocks on the New York Stock Exchange making new highs was deteriorating. And this is very important because we see this time and time again. This is 2008, 2009, as you guys recall. Here's the S&P 500, and here are the list of stocks on the New York Stock Exchange making new 52-week lows. So notice how the market, the S&P 500, didn't put in its epic bottom until March of 2009. However, the market itself put in its bottom in October. The most amount of stocks making new 52-week lows was in October. So on the lower low in prices in November, the S&P 500 in 2008, a majority of stocks had already bottomed out in October, and we had fewer names on the New York Stock Exchange making new lows. And by the time the S&P 500 and Dow put in its lows in March of 2009, pretty much everything had already bottomed. So the internals of the market had already been improving for several months, well before the indexes. So we want to look at the breadth of the market, the internals, for indication of what's to come. So how does it look today? Here are the list of stocks on the New York Stock Exchange making new 52-week lows. And one of the reasons that we were so bullish at the end of January and early February is because on the lower low in price in the S&P 500 into February, we had half of the amount of new lows on the New York Stock Exchange at that point. So we saw a huge improvement of breadth in February, and we were extremely bullish. I will show you some other factors as to why we were actually bullish at the end of January, and what we saw in February more so confirmed what we had already been seeing elsewhere. But again, it's taking the weight of the evidence, guys. It's not that I'm this expert options trader that's going to show you all these fancy iron condors and this and that, or, you know, I focus in on commodity futures. No, it's taking that information from the options market. It's taking the information from the New York Stock Exchange. It's looking at the major indexes. It's looking at the commodities, taking all of that weight of the evidence and bringing it all together to make an educated decision with a favorable risk-reward opportunity, which is really all of that matters, guys. So when you talk about what the market looks like today, we had higher highs going into April in the S&P 500 and Russell 2000 and some of the major indexes, but notice how the list of stocks on the New York Stock Exchange making new 52-week highs has been deteriorating the entire time. So while the market quote unquote may have made a new high last month before it started rolling over again, the internals had already been suggesting that there was weakening breadth in the market. Also, we want to look at the advanced decline line. The advanced decline line, all it is just a running total of the number of stocks going up minus the number of stocks going down, right? That's really all it is, hence advanced decline line. So this is the advanced decline line of stocks on the New York Stock Exchange. And notice how the S&P 500 may have come within a couple of percentage points of making a new high, but the advanced decline line got nowhere near there, right? So we got to those 2014 highs, well before that failed breakout from last year. The key resistance in the AD just above 10,400, and another bearish momentum divergence at the recent highs, and we started rolling over from there and actually closed at new fresh lows on Friday. So again, more evidence is suggesting that the breadth in the market is weakening. So let's look at the indexes itself short term. I see you guys have been asking me, what do you think of the S&P 500 now, etc. So here's the NASDAQ composite, and I see here is lower lows and lower highs. So this is a downtrend with a downward sloping 200-day moving average. So there's nothing here that suggests we're in an uptrend. Here's the S&P 500, lower lows, lower highs, downward sloping 200-day moving average. Nothing here suggesting this is any kind of an uptrend, because by definition, lower lows and lower highs is a downtrend, right? So here's the S&P 500. You have a failed breakout, which is, again, why I wanted to discuss these failed moves. You had a failed breakout last month above the downtrend line from the summer highs last year, a bearish momentum divergence, and this is a short as long as we are below that downtrend line. Here is the Dow Jones Industrial Average, same thing, failed breakout above the downtrend line from last summer's highs, bearish momentum divergence. This is a short as long as we are below those downtrend lines. And again, from a risk-reward standpoint, guys, what's the risk? This is the risk. If we're above this downtrend line, then this thesis is clearly wrong. So that's the risk. It's very well defined. It's very minimal. And if you're wrong, so what? The risk is very minimal. If you're right, it's a home run. We make new 52-week lows, and it makes your year. Dow Jones Transportation Average, failed breakout above the downtrend line from last spring's highs. Bearish momentum divergence at the recent highs. So we want to be short as long as we're below that downtrend line from last year's highs. Does it work in inverted ETFs? Of course. Looking at this market and then choosing how to best execute is up to you. If you want to be in options, if you want to be short the indexes, if you want to be in futures, it all depends on who you are as an investor. For you to define your time horizon and define your risk parameters, right? So if you're better off in options, go for it. If you're better off in futures, that's you. If you want to be in inverse ETFs, that's the way you want to execute. But the analysis itself, regardless of how you want to execute, remains exactly the same. So here's Dow theory, guys. This is still in a sell signal. This is when you have the Dow Jones Industrial Average and Dow Jones Transportation Average. You want them to confirm one another. So if you have highs in one, you want highs in the other as well, right? So first, there's a group of companies that makes the products, and then there's a group of companies that delivers them, right? So those are the industrials and the transports. And notice how we took out the fourth quarter highs in the Dow Jones Industrial Average, but in the transports we got nowhere near there. So that bearish divergence between the two indexes suggests being short. Here's the Dow Jones Transportation Average relative to the S&P 500. This was the leader. It bottomed in January, and we are running into that resistance. More evidence that this is a short, both on an absolute and relative basis. This is an underperformer going forward. Here's the NASDAQ 100, broke the uptrend line from the February lows. Bearish momentum divergence. This is still the short as long as we're below those levels. Russell 2000, failed breakout above the downtrend line from last summer's highs. This is a short as long as we're below that downtrend line. Mid-cap 400, bearish momentum divergence, broken uptrend line, failed at former resistance. Are you guys seeing how there is just more and more evidence? It's not just one indicator. It's not just one thing telling us to do something. It's everything together. New York Stock Exchange Composite, failed breakout, bearish momentum divergence. We want to be short. Dow Jones Composite Average, which includes the industrials, the transports, and the utilities, failed breakout. We want to be short as long as we're below that downtrend line. Again, more evidence that suggests that. The dollar-yen, very, very positive correlation with the S&P 500. Notice how we had a failed breakout in 2007, right before the market peaked, and then both crashed simultaneously. We had an eerily similar situation last year, failed breakout above that 122 level and down we go. If this thing continues to fall, further evidence that we want to be short. And here's the Japanese yen breaking out. This is the yen itself. So Why we turned bullish in February? This is the exact opposite of what we're seeing now. Bullish momentum divergence, failed breakdown in Russell 2000. This is February. XOP, this is the energy sector, bullish momentum divergence at support. It was a buy. Emerging markets, bullish momentum divergence, failed breakdown. It was a buy. This is all in February and January. Emerging markets, failed breakdown, bullish momentum divergence, breaking out above a downtrend line. It was a buy. Gold miners, failed breakdown, breaking out above a downtrend line. It was a buy. China, getting to support, bullish momentum divergence, buy. South Africa in January, failed breakdown below the extension, bullish momentum divergence. It was a buy. And these aren't just hindsight trades, guys. This is on All-Star charts, January 26th, time to buy South Africa for a trade. Right here just above 40, bullish momentum divergence. Home run, guys. So we're now seeing the exact opposite. This is one of my favorite sentiment cartoons. I'll send you, we don't have a lot of time, guys, so I want to make sure that I get to what I think about the markets today, so I'm happy to send this to you, the entire slide deck. If you guys email me, here's technology on a relative basis just crashing. This is the largest sector by market cap in the S&P 500, and it is a disaster, not bullish. These are the relative rotation graphs. I'm happy to send these to you guys. Our members at All-Star Charts have access to all of this, essentially suggesting to us that utilities and staples are now weakening and are moving into the lagging sector from a longer-term time horizon, and from a shorter-term time horizon, you have utilities and staples kind of shifting into leading. So you want to look at both time horizons to see where money is flowing into what sectors. And here's consumer discretionaries relative to consumer staples, high correlation with the market. This looks like it's heading lower. Again, I wish we had more time to discuss why some of these things are more important and why it is that I'm showing them to you, but we really don't have that much time, guys. I want to get into some of the trades. Here, something I think is important to discuss. Here's consumer discretionaries relative to the S&P 500, regular weighted, where Amazon represents 11% of the consumer discretionary space, attempting a breakout. But when you put it equal weight, where every single stock in the index is exactly represents the same amount, it looks like a disaster. Look at the difference between a cap-weighted consumer discretionary and a equal weighted. Big difference. So that's Amazon. So here you have your equal weight discretionaries crashing, made new lows on Friday, a very important sector for the market, literally going straight down. We want to be short regional banks as long as we're below 41, bearish momentum divergence, price target hit, we want to be short the banks. Same thing here, bank index relative to the S&P 500, finding resistance, we want to be short the banks. This is XLF relative to the S&P 500, finding resistance again, we want to be short the banks. Bank of America, former support turns into resistance, we want to be short Bank of America as long as it's below 15. Citigroup, former support turns into resistance, we want to be short Citigroup as long as we're below 47. The one we want to look at, guys, is European banks relative to U.S. banks. If European banks continue to crash, this stock market is not going higher, guys. We close at new lows in European banks relative to U.S. banks on Friday. Here are European banks on their own. That's a downtrend, guys. It's going lower. Momentum in a bearish range. We want to be short European banks. European banks are now breaking the uptrend line from the February lows. Momentum is in a bearish range. We want to be short European banks. Here is Credit Suisse not finding any support. We want to be short Credit Suisse if we're below the downtrend line from the 2009 lows. Here's a shorter term outlook of Credit Suisse breaking this consolidation below former support in 2012. Credit Suisse is a short. Deutsche Bank below support, continuing. Momentum in a bearish range. We want to be short Deutsche Bank. Here are European banks relative to Europe as a group. So this is saying European financials relative to the Euro Stoxx 50, which is the Dow Jones Industrial Average of Europe. German DAX to short. Crude oil, we want to be long as we're above the downtrend line from the 2014 highs. I think we're going to 50. Crude oil relative to the S&P 500, finding support at the 2000-2001 lows. Bullish momentum divergence. Crude oil is here to outperform. All right, guys. So real quick, I want to look at interest rates. Here's the 10-year yield. It's breaking down. I think we want to be looking to buy bonds 100%. This is the 10-year note in the CME breaking out above a multi-year consolidation. There's nothing bearish about this. I think bonds look great. The yield curve, this is 10s minus 2, looks like it's going to 0. 30s minus 1s, again, the yield curve looks like we're heading towards inversion in both of those. Gold, Longer term, I like it. Short term, we hit our upside targets. The time to be buying was in January. We want to be taking profits at 1,300. The hedgers dumping it. This is the smart money getting out of gold. We want to listen. Silver, the breakout at this point is where we wanted to buy it. We ran into 18. That was the target. We want to be taking profits. The commercial hedgers, the smart money in silver, they're dumping it at record levels. But bigger picture, I still like it. We want to be buyers in precious metals. Here's gold price in Australian dollars breaking out. Gold price in Canadian dollars breaking out. Gold price in British pounds breaking out. Gold price in emerging market currencies breaking out. So bigger picture, gold price in copper breaking out. Bigger picture, we want to be buyers of dips in gold. We do not want to be buying gold today. Gold relative to the S&P 500 breaking out. Gold relative to silver selling off. Every time the gold-silver ratio gets in the low 80s, it crashes. We want to be short the spread. Short term, sure, we can get a little bit of a bounce. We want to be fading the spread in the mid-70s. So finally, guys, I'm just going to give you a quick tour of allstarcharts.com. We have a chart book where we have 400 charts where you can access to them, all 30 Dow components, all of the major sectors, whether it's gold miners or biotechnology or energy or financials. I'm looking at daily charts and weekly charts for the entire chart book, and there's almost 400 charts for you to access, all of the major commodities, etc. One of the best values, I think, one of the most important aspects that our members seem to love is the weekly letter, which goes out every Tuesday or Wednesday, which talks about what we think about the stock market, both U.S. and globally, what the commodities markets are suggesting, what we want to do to take advantage of that, whether it be in metals or in agriculture like corn or sugar, or in energy like natural gas and crude oil, right? It also has individual stock ideas that we'll get into in a minute. I'm about to show you guys what I think is the best trade right now. But this seems to be one of the favorite aspects for our members. We have a trade ideas page where you can go down and everything is organized. Some members were suggesting that there might be too much research to keep track of. So this helps keep track. You can just go to the trade ideas page and see what JC thought a month ago, what JC thinks today, et cetera, and that's updated all the time. By far and away, our members love the monthly conference calls. It's very similar to this, except less education, because our members can access all of the educational stuff separately and really just gets into what we want to be buying, what we want to be selling. Yes, Jimmy, we're giving entry prices and exit prices, and more importantly, the exits on both when we want to take profits and where we would be wrong. So yes, 100%. And then we have a member forum, of course, where our members like to interact and share ideas. And after all of that, if you still have any questions, whether it be regarding something I may have said in a monthly call or in a letter or in a separate post, you can always use the member contact form, and I am happy to get back to you within 24 hours. Our members love this aspect as well. So traditionally, we offer a quarterly membership for $397 and an annual membership for $1297. But today we're slashing that for you guys. We're knocking $100 off the quarterly membership, which is now $297. You can go to allstarcharts.com/profits, which you see down here in the lower right. You get access to the entire chart book, the weekly newsletter, the actionable trade ideas page, the monthly conference call, direct access to myself, and most importantly, a 30-day risk-free trial. So you have nothing to lose here, guys. Step up. Quarterly membership is $297 and annual membership is $997, and the best of all is that it's a 30-day risk-free trial. So if it's not for you, if for whatever reason you find value in something else or you're not finding value in this, we give you your money back. Happy to do it. So again, a 30-day money-back guarantee. So these are some of the testimonials that we've had from members. This is Jack in Orlando that says All-Star Charts is a fantastic service. The level of dedication JC puts in to his work is outstanding. Not only does he provide you with a multitude of trade ideas, but he also breaks down his reasoning. So you're learning in the process. Highly recommended. Thank you, Jack. I think that one of the common denominators that we're seeing is that members are telling me that it's not just about what to buy or how to buy, but more so how to think and how to approach the marketplace. So I think it's bigger than that. Yes, stocks, bonds, commodities, foreign exchange, intermarket relationships, yes, Jose, across the board, because this is 2016. So to be focused on one asset class, I think personally is irresponsible. I think if we have access to these other markets, we should be able to participate them as well. Jesus wants to know if it's easy to cancel, and yes, it is. Just send us an email and cancel right away, no questions asked. Randy, the amazingly transparent weight of the evidence approach, coupled with clear entrance and exit prices and recommendations based on that approach, has led to extreme profitability for me. Any technical analysis-based trader must use allstarcharts.com. There is nothing in the world of trading and investing that compares. Thank you, Randy in New York. For anyone who does not want to get caught up in the daily or hourly noise of the markets and wants actionable levels to trade from, All Star Charts is unquestionably the greatest resource I have found, and I have looked at a lot. I still do utilize fundamental analysis, but JC's technical analysis has contributed in me having more confidence in my picks, as well as assist me in the general trend of markets and sectors. And now my trade of the week, really. You guys can go to allstarcharts.com/profits in order to access the discount, Jimmy. So the trade, I think, is Apple. The more times that a level is tested, the higher the likelihood that it's going to break. Support, 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 and we broke. This is 92 bucks. If we are below 92, we want to be short Apple and covering down here near 80. This level represents former resistance and this gap in early 2014, but is also the 161.8% Fibonacci extension of the entire February to April rally. So 80 bucks, when we get under 80, that's when we want to be covering our shorts. And here's a closer look from a risk management standpoint. Momentum is now in a bearish range, and if you look down here, I'm going to go into the chat. Would you mind, Reed, putting allstarcharts.com/profits into the chat so that everybody has access to that? That would be terrific to the entire audience. allstarcharts.com/profits. Can you guys see that? Can you guys see that? That'd be terrific. Thank you so much. So Apple is the short. If we're below 92, it's a short. We want to cover under 80. So that's the level, guys. If you have any questions at all, please feel free to to reach out. You can go to allstarcharts.com/profit. It's $297 a quarter, $997 a year. This is a huge discount, and more importantly, it's a 30-day money-back guarantee. So if for any reason you're not satisfied, we don't even care why. If you want to tell us why, that's fine, but we don't even need a reason. Happy to sign you up. So you go to allstarcharts.com/profits. As you can see here, the offer is expiring soon. You sign up for the 30-day risk-free trial. Right here, $997. Start your risk-free trial. It takes you directly to the website. You fill in your name, boom, and you're done. It's that simple. Here's Howard Lindzon. JC looks at the markets in a different way than I do. He lives and breathes what I call chart art and relative pricing. Most importantly, though, he makes me money. Guys, this is a millionaire venture capitalist in California saying nice things. So, guys, by all means, allstarcharts.com/profits. We have our monthly conference call was this past week, and you can access that immediately after joining. Just go to the conference call archives, and you can listen into this week's conference call for more trade ideas and a better outlook towards the overall market, better than what we were able to do today in a short period of time.